I used to think finance was untouchable, a fortress guarded by suits, jargon, and systems so old that nobody inside them even remembered why they worked that way anymore. And that belief came from watching banks survive scandal after scandal, while startups around them burned out chasing permission they would never be given. But fintech didn't rise because startups suddenly got smarter than banks. It rose because finance quietly stopped serving humans, and fintech founders were the first ones desperate enough to say it out loud. The rise of fintech is not a technology story. It is a frustration story, born from millions of small humiliations people learned to accept as normal when dealing with money. Traditional finance didn't feel broken to insiders. It felt optimized, processes layered on top of processes, fees justified by complexity, delays framed as security, paperwork defended as compliance. From the inside, everything had a reason. From the outside, everything felt hostile. Waiting days to move your own money. Paying invisible fees you only discovered after the fact. Being denied services without explanation. Entire populations excluded because they didn't fit a checkbox designed decades earlier. This gap between institutional logic and human experience is where every real disruption begins, not with innovation, but with resentment. Fintech startups didn't start by trying to rebuild the financial system. They started by picking at the edges where pain was most obvious. Payments that were slow and expensive, lending that punished the wrong people, banking apps that looked like accounting software instead of something you trusted daily. The early wins weren't glamorous. They were basic. Faster transfers, clear balances, transparent fees, mobile-first access. Things customers had been asking for quietly for years, while incumbents told them it wasn't possible or wasn't safe. What made fintech dangerous wasn't the code. It was the narrative shift. Startups reframed finance from an institution-centric system to a user-centric one. Instead of asking, how do we manage risk, they asked, how does this feel to the person on the other side? That question sounds soft until you realize how radical it is in an industry built on asymmetry. Banks knew more than customers and profited from that gap. Fintech tried to shrink the gap, and shrinking asymmetry always threatens incumbents more than efficiency ever could. I've watched founders walk into fintech thinking regulation was the enemy, only to learn the real enemy was inertia. Regulation can be navigated. Inertia fights back silently. Legacy systems, internal politics, revenue streams that depend on friction. Startups didn't beat banks by outspending them. They outpaced them by not needing to protect the past. When you don't have branches to justify, you don't need people to come in. When you don't have COBOL systems, you don't fear shipping updates weekly. When you don't make money on overdraft fees, you don't design products that trap users accidentally. The first wave of fintech success came from making finance feel less intimidating. Clean interfaces, plain language, notifications instead of statements, education embedded into flow instead of hidden in PDFs. This wasn't design theater, it was trust building. Money is emotional. People don't just want accuracy, they want reassurance. Fintech apps that acknowledged anxiety instead of ignoring it earned loyalty far beyond their feature sets. Then came the deeper shift. Data. Fintech didn't just digitize finance, it reinterpreted it. Creditworthiness stopped being a single number and became behavior over time. Risk models expanded. Underwriting changed. People who had been invisible to banks suddenly had access. This wasn't charity. It was better math applied with fewer prejudices baked in. When startups could prove that exclusion wasn't just unfair, but inefficient, the argument stopped being moral and became competitive. Of course, not all of this was noble. Some fintech companies simply recreated old traps with better UX. Dark patterns replaced fine print. Growth chased valuation instead of resilience. The same pressures that corrupted traditional finance didn't disappear just because the founders wore hoodies instead of suits. Fintech didn't magically become good. It became possible. Possible to move faster. Possible to experiment. Possible to fail loudly instead of hiding mistakes behind institutional opacity. What truly reshaped finance wasn't one killer app. It was unbundling. Payments here. Savings there. Investing somewhere else. Each vertical attacked by a specialist instead of a universal bank pretending to do everything well. This fragmentation confused incumbents and empowered users. Choice returned. And when choice returns, loyalty has to be earned again instead of inherited. But this is where the story tightens, because once fintech proved it could attract users and capital, it ran headfirst into the same question. Every disruptive industry eventually faces what happens when trust scales faster than responsibility, when growth outpaces governance, and when startups that promised to fix finance begin to look suspiciously like the institutions they once criticized, as the sentence continues into the next phase, where fintech's rise forces a reckoning about power risk and what kind of financial system is actually being built for the future, where growth stopped feeling like liberation and started feeling like weight, because once fintech companies crossed from clever alternatives into core financial infrastructure, they inherited the same burden banks had carried for decades, just without the muscle memory to manage it. When you hold people's money, you don't get to experiment casually anymore. Speed becomes dangerous. Innovation becomes liability, and the same users who applauded disruption begin asking harder questions about safety, stability, and accountability. This is the phase where fintech's self-image was tested. Early narratives painted banks as villains and startups as saviors. Reality was more complicated. Risk doesn't disappear because an app looks friendly. Compliance isn't optional just because onboarding feels smooth. Some fintechs learned this the hard way. Outages, frozen accounts, sudden policy changes, and opaque decisions that felt eerily similar to the institutions they replaced. Users realized that trust is not about UX. It's about what happens when something goes wrong. The most mature fintechs responded by slowing down deliberately. They invested in risk compliance and governance before regulators forced their hand. They accepted that being bank-like in responsibility was not betrayal, it was graduation. The immature ones chased growth at all costs, subsidizing users, bending rules, and hoping scale would outrun consequence. Those companies burned brightest and collapsed fastest. Finance has always been unforgiving to hubris. Technology doesn't change that law. What became clear is that fintech's real impact was not destroying banks, but forcing them to change. Interfaces improved. Fees became harder to hide. Transfers sped up. Language softened. Competition returned to a sector that had forgotten what it felt like. Banks didn't lose because startups replaced them wholesale. They lost their monopoly on indifference. Fintech made customers remember that better was possible. And once people remember that they don't forget easily, the next evolution is already visible. Fintech is recombining. Super apps, embedded finance, banking everywhere, not as a destination, but as an invisible layer inside other experiences. This raises a new ethical challenge. When finance disappears into flows, who is accountable when something breaks? Convenience increases. Transparency risks shrinking again. The same asymmetry fintech once fought can quietly return in a more elegant disguise. So the rise of fintech is not a victory lap. It's an open question. Will these companies institutionalize the empathy that made them trusted, or will they drift toward the same extraction logic they once criticized? Will regulation be seen as an enemy to dodge or a boundary that protects users? The answers are being written right now, not in code, but in incentives governance and the willingness to trade explosive growth for durable trust. For builders, the lesson is sobering. Disruption earns attention. Stewardship earns longevity. Finance magnifies both. If you remove friction, you must replace it with responsibility. If you take control, you must accept consequence. Fintech succeeded because it made money feel human again. It will endure only if it remembers that humans are fragile, anxious, and deserving of systems that protect them when optimism runs out. And if this story of Fintech's rise and reckoning resonated with you, stay with this channel. Subscribe, because this is where we talk about what happens after disruption succeeds. And leave a comment sharing whether Fintech made your relationship with money better or just faster, because that difference will decide whether this transformation becomes progress or just another cycle repeating itself with nicer interfaces.